Hello everyone. So this is Venkatesh Deshpande. As last time we discussed all about what are the different aspects of mutual funds. For example, we last time had an analytical discussion, and in comparison of the direct mutual funds, or you can say what is the difference between the index funds, or you can say passive mutual funds or active mutual funds. So we will discuss today in greater detail about what is passive mutual fund management and their schemes, and then how it differs in comparison with the active management mutual funds, right? So though in recent terms, I think many of the investing community, or you can say the trading community, they know that mutual funds are going to be their second choice, as they are thinking themselves that they can better manage their own fund by using the direct stock investments, right? So there are some great thing about the direct stock investments, and there are some things which you cannot avoid. There are certain conditions where the mutual fund uh, makes sense in many cases, right? But I'm not recommending the one objective here. So my personal feeling is, let everyone know everything about it, and then it is individual intelligently selecting what suits to them. So that is what is my idea since beginning, when I started educating people through this financial literacy. So the today's object would be, what is the difference, the key difference between the active mutual fund and passive mutual funds. Somebody called as the index fund, or you can also says indexing, the regular mutual funds and the index mutual funds. You can also call passive is index mutual fund, active is a regular mutual fund, right? So then we'll talk about what is the key difference between them and what is the best thing to do among them. So obviously my always goal would be to educate you to the best aspect, so that it will be easy for you to decide, and sometime I will go unambiguously and suggest few things which is very good for you, right? So that's why you stay tuned, and go ahead and have these all discussions and note them out, and what I'm talking here may come along with greater depth of analysis after my years of experience, right? So hence we'll start today. So the one which the fund which you're seeing here is top 100 HDFC top 100 fund direct plan growth. The name itself suggests, right? Earlier the mutual funds were not offered through the direct way. They were like earlier the HDFC top 100 fund plan growth. I'll keep there are many people viewing this may understand what these individual terminologies is, but as I want to bring everyone into the same page, first I'll start explaining from growth. What is growth? Let's say if you have put 1,000 rupees in a mutual fund, or 10,000 rupees, or 1 lakh rupees in this mutual fund, okay? Particularly this is known as scheme. This what I'm highlighting is a scheme offered by HDFC AMC Asset Management Company, and the scheme type is growth type. In the sense, when you invest 10,000 rupees, so they will buy a share for you as per their investment fundamental scheme or the principle, and they will buy those securities or the stocks, and they'll keep into this particular fund, and that fund will never pay you back either in the form of dividend or in the form of anything till the time you redeem this fund. So they will reinvest everything, whatever you will get directly from the security, such as, see, when you invest in a stock directly, you will get regular dividends, right? I'll talk more on dividends. First, to understand what is growth means, the moment when you give something to the AMC, they will not pay you back anything interim. So they will keep on accumulating your returns and reinvest them back into the same scheme and grow your money. That is known as growth scheme. Hence, anybody who is interested to invest in mutual fund will have to predominantly choose growth fund if you are young investor. right? So if you are now 50, 60 years plus investor, then you may think, okay, I have 10 crores, I have 10 lakh, I have 1 lakh. When I put it, because I am a retired person, I need a monthly income. Then there can be a plan called the dividend option, right? So that dividend option or monthly income plan, or all those different, the same fund, HDFC top 100 fund, offer many sort of the scheme category type available. So as we are talking about the multiplying our growth, and we are talking more of the investing for the long term, we don't want to go with that other anything other option other than growth. So that is a good way to go in. So what when we're talking about estate to top 200, when I read it like this, direct in the sense, there is no broker or sorry, there is no commission, there is no agent who are distributor of the mutual fund involved here. So you as a knowledgeable investor go into directly the applications like Grow or applications like Coin of Jiroda, and when you log in and when you select these funds, understand them completely and buy them. This mode of application or the investment is known as direct plan. And HDFC's AMC top 100 is their approach or the scheme theme behind running this particular scheme. They are saying top 100 companies. When they say top 100, they are talking about the top 100 market capitalization companies. Market capitalization, last time when I said the top 100 companies of India, the top biggest 100 companies of India, they will target and put their money into this particular fund. So idea here is the mutual fund manager will get the money from you, and he will invest on behalf of you in this particular scheme and generate return. So you may be seeing this fascinating result of mutual fund which is giving you 1 year 57.3% return. Don't get carried away. This is not a real-time scenario which happens every year on year basis, right? This is obviously from the very low bottom we hit onto the Nifty, and then in the sense stock market crashed during the COVID time, and from there it's been 1 year, and hence it is 60%, close to 60% return. Don't expect more than 12.5% return, from 12.5 to 14.5% return every year on year CAGR on your mutual funds, okay, on the direct or the regular funds. Okay, so then why I'm not advocating, or why I'm not suggesting these regular funds? The only reason why it has to be, not suggested to you is, so when you, and how to analyze the mutual fund. Okay, so when you see this, you will be able to see the return. Okay, it's 1 year, 60% return, close to, and the name NAV, net asset value of your investment, is increasing like this, going up and down based on the stock market direction, where the stock market is up and the NAV will go high. When the stock market goes down for interim reason, that's the nature of the stock market. It goes up and down, up and down. Based on that, your NAV will change. NAV is nothing but a net asset value, which is a combination of many other computations that AMC do based on the investment they made into different stocks into their particular portfolio. So that is the determining value of the NAV, right? So you don't have to, as a beginner, you don't have to break your head on what is NAV and how to compute it. It's none of your business, because it's done completely transparent manner by your AMCs, right? So when the when the NAV goes up, your value will be more, and NAV will be less. As the, if in 2020 you have 459 one unit you would have got for this, and the same unit is now 668 rupees. Hence your 450 rupees worth of investment, particular point has now become close to 670 rupees. So hence there is a predominantly around 60% of the growth in one particular year, right? So, and I'm talking about not in terms of return yet, because I need to educate you a lot on stock market, right? So don't think this is the only parameter. I'm now educating you how to select a mutual fund, what are the inherent properties you need to understand among the mutual fund. One is anyway, obviously, it will be invested into the equity and or the stock market. That stock market up goes, swings either direction, both up and down. So that you need to bear upon. And there are other aspects like, see, they are very clearly saying the fund details. The risk is very high in the sense volatility. When we say risk, it's a volatility, and it's a minimum investment is 500 rupees. You can start with 500, and your net asset. This is some statistics about it. And fund size, when you see 20,041 crore has been invested. 20,000 plus amount has been invested in the same mutual fund. It is top 200, top 100, and the expense ratio. Okay, for every 100 rupees for them to manage your money, we are paying them 1.26 rupees. Okay, 1.26 percentage is your expense ratio. This is, please note down, this is very important aspect of your the thing which we will discuss in the index mutual funds. And the return is, for 1 year it is 57%. I was letting you know before, don't carried away with this particular return. As you see, in 3 year average return is 12.3% just, and 5% return is around 14%. Since inception, since beginning of this fund or the launch of this fund, it just gave you 13.1%, right? This is the reality, not this one, right? And when you go to category average, in the category average, it performed well. In its category average, it performed well. This is a category average, and this is a fund return. So here the performance is comparatively good than the peers in this category. So, and duration, all those things is blah blah is fine, but the important aspect here is fund name. Okay, so these are the comparative funds. I mean, you can say similar funds in the category, right? You can choose among them as well. So, and then the important aspect, you need to come down and here and see. Okay, you may be able to see here a top holding of this fund, particular fund. It is anyway 100 stocks it should hold ideally based on its theme of or the name of the mutual fund suggests. It has HDFC Bank, one of the leading Indian private bank, ICICI Bank, State Bank of India, Infosys, Reliance Industries, and you can see here their investment proportion. Okay, if 100 is invested, 7.8% of the 100 is invested in this HDFC Bank itself. This is fund allocation. And if you can click on this, you have a large list of all the securities or the stocks which are there listed here, right? There are around 100 stocks, right? Or less than that. Their categories say 100, but it's up to the fund manager that what a number of the stock you want to hold, he can very well decide upon. Your job is to just lend your money to him, give 1.25% per annum, the interest, sorry, the management fees, and sit tight on the investment to your investment to grow. This is a regular fund. Why I am talking about the index mutual fund? Okay, when we saw this one, top 100, we saw. Now we saw this. Okay, how to search for the Nifty index fund? Yeah, here. So if you see here, this is Nippon India Index Fund, Nifty Plan, Direct and Growth. So what is the difference between this and that? So this is a regular plan, and the same is this. This is a direct plan. So this is a regular plan, and this is, you can say, indexing. Indexing in the sense, we have Nifty 50. Okay, Nifty 50. When we say, it has list of 50 companies based on their market capitalization. Okay, so if you go to Nifty and for example, when you say Nifty 50 list of companies. Okay, so when you, I mean, I'm just enabling you to how to read this information. So if you go here or in this is a Nifty website, which is our national stock exchange, maintains this website. If you go and see there, you will see the Nifty 50 companies. Right? So basically, it is top 50 companies in. Okay, rather this is not a. I will directly open NSC website. So here you will get this list, right? So this is all about Nifty 50, and Nifty 50 has these many 50 number of stocks, right? ONGC, and you will have Reliance. Also, you can list the, you can list them or basically filter them based on their market cap. So this is a 50 company list. What this particular fund is doing is, instead of fund manager thinking and using his brain, lot of research and lot of analysis of entire stock market and entire list of securities traded and invested across, he will just go by this national stock exchange and the Nifty companies. Okay, well, 50 companies, 50 largest companies of India. He don't do any research at all. He will just go this list and take the number companies in this particular list, and he will just automate the process of investment. When somebody pays his money, he will proportionately invest all his money, the investors money, into this 50 stocks. No research, nothing is needed to is the fundamental principle of this particular investment plan. So you can see here, earlier with this we got 57% return, and here we got very same return, right? This is also giving you 57% return. This is also giving you 57% return. Some variation of 0.5, 0.8% is okay, right? There's no difference. But what is important to understand here is the expense ratio is 1.26, and the expense ratio here is we can go wonder why it is. It's just percent, 0.2%, right? You will be charged only 20 paisa on your investment of 100 rupees. There you will be charged 1.26. In the sense, this is lot more cheaper than compared to what is there in this particular fund. Okay, so to get the same sort of return every year, you are paying 1.26 rupees here, and but the same return is being obtained by just paying, okay, 0.2%, 20 paisa. Okay, hence nowadays entire investment approach or investment crowd is going into this particular index. There are pros only, very less cons, right? And I want to make you understand this fully, because in a single video I don't think I will be able to complete all the aspect of it. There is a great guy, John C Bogle. Okay, he is a founder of Vanguard 500 fund. Maybe these are the classes or the discussions I'm making, uh, you know connect, trying to connect with you is elaborate things and ask you to go and read many things, right? So that is my idea. So the Common Sense Investing is a great book, and I would really recommend you to go through this book and understand well. So this is a very, very fantastic book written on how one should think about investment, how one should give an attention on what the common stock investment, what is mutual fund, what is regular funds, what are the index funds. And this guy is a pioneer of index fund investment, paradigm started with him. So hence this book is wonderful, and you can go with it. And there is another guy, his name is Tony Robbins. He wrote this Money Master Game. So this book all teaches you is all about what is investment, what is stock market investment, how it really been done successfully. And many investors fail to understand what are the stocks and what is mutual fund, right? So this guy is a very, very, this is a masterpiece. What he did is Money Master the Game. So this is a very good book, and these two things. There are so many other books rather. This is also one of the great book, and but I'm recommending you to go along and read these two things: Money Master Game and Common Sense by John C. Bogle. So these books are predominantly talking about, you know, risk less investment approach or the strategy. Nowadays, people are really euphoric on what is stock investment, what is the individual stock picking, how to invest them, how to research the company, and what are the risks involved, and how to deal with the inherent risk of stock market volatility. And when you see, when you are investing, you will go along with the crowd. Okay, everybody is investing and everybody is earning like 5%, 6%, 10% in a month. Why I'm kept myself out in this particular, journey of investment where others are getting advantages I'm not getting. So this is also known as fear of missing out. Okay, FOMO, it's a short form. Nowadays it's circulating across. So fear of missing out makes people, get them enter into the stock market at the wrong cycle or the wrong price of stock market valuation. But these two books make you understand, okay, it's not that way. One should, think of investment. It is the right approach. What is the right approach, and when we should start investment? These two books really, are the eye openers, right? So coming back to this direct fund, sorry, the index fund investment, lot of advantage. You may be thinking, okay, what is their 1%? uh, what why I'm suggesting 1%, because both are giving the same return. If it is 1% is matter, why should I really say, okay, in Nifty, sorry, the indexing is a great thing. It is not 1% which think on current investment corpus. Let's say if the corpus is more than crores, more than 10 crores, that time this 1% makes a real difference. And at the end of your investment, these books will tell you with a perfect statistical calculation that when you give the money to this particular people, okay, and they will, eat your mutual expense ratio of 1.26, where this is just 0.2%. The difference is very shocking. And at the end of your 25 years investment, you would be paying 26 to 30% to back to the AMCs along your investment horizon with them. That is really bad, right? Hence, in already in US and Japan and Europe, the people have already ditched the regular plans, right? Regular direct plans as well. Earlier, when I started investment in my early phase of investment, I used to pay for the mutual fund 3%. Can you imagine? It was ridiculous. 3%. If your 100 rupees is getting managed, you were paying to the AMC that 3.4%, 3.6% as an AMC charges. That was ridiculous. Then SEBI came in, okay, somebody who understand the mutual fund, let's not be a commission. Then they became the investment, the AMC charges or the expense ratio became around 1.8 or 2%. Then they came along with the indexing, and then it is just, 0.2%. The same company, it's the same Reliance. This was Reliance before, now it's India, in Nippon India. The same AMC offers direct plan, I mean regular plan as well as index plan, but the expense ratios are directly different, right? Hence the expense ratio is the important aspect you can't even ignore. If the expense ratio is okay, if it is 0.2%, if they are giving you the euphoric return, then compared to what these people are doing. Okay, sorry, I'm going the other way around. This HDFC top 100, if it is giving 90% return or 75% return, or at least 60% return, sorry, it is anyway 60%, I mean 57%. If it is giving 60% return, 3%, then this particular mutual fund, then you would have considered it. But it is it is exactly same. And these books, if you go by these two books, historically in US or anything else in the world, anywhere else in the world, in India, India is anyway the investment cycle started in, I would say, around 1978 or 1976. But in US and all, the investment and the stock markets have started way beyond 19th century. I mean, you can say 18th century they have started with, right? So since then, that statistical data says that the regular funds never would be able to cross easily these index fund performance. Hence, giving your money to the mutual fund where they charge heavily and returns you the same or less percentage than compared to the index fund, that is not a wise approach. Hence, I would urge and recommend you go only for index mutual funds. Okay, and this is today's video all about how to select a mutual fund. And this is one of the site I just took an example, no recommendation. You can search over, and also I can make another video how to really get the best mutual fund platform to invest and get a better return without paying or paying very less fees for anything else that you are thinking and planning to go ahead. So I will talk more about the fundamental reason why they can't overperform than compared to the index fund, and what is the indexing approach, and what all it takes to for you to be a winner. What is stock market, for example, how the companies are being traded, how the people have been investing into the stock market. Obviously when we talk about the index mutual fund, Nifty 50 or 50 companies or 100 companies, so underneath securities have to perform finally, right? Underneath investments or underneath the stocks have to be individually performing. Then only these mutual funds will they are just a reflection of those list of 50 companies performing for you, right? So yeah, this is for today. So my strong recommendation is, if you want to start with your investment, start with Nifty 50 index fund. It is not Nippon India Fund Nifty plan. This I just took for example purpose. There are so many AMCs offering you Nifty 50 index fund, and here the ambiguity is very less. What should be your search criteria? You search into this particular site or whatever, you go for Nifty 50 index fund. Among all the mutual funds which you see, you should select the one which is offering you least expense ratio. That's it. Blindly investing. So it is that clear when you try to invest into the index fund and research over it, right? If, for example, if you come to the regular plan, there are lots of if and buts, and their performance, their this thing, how is the fund manager, how is his investment approach, how qualified he is, the stock research, all those will be your consideration. But when you come to the Nifty 50 index investment, it is for sure the list of companies, how they are performing. It is just a platform or a vehicle you need to invest in those companies and get the return. That's it. And hence they are offering you very least expense ratio, because they also know they are not doing any research, they are not doing any greatest thing for make you to get a better return. They are just taking your money, putting in the fixed list of companies which is listed onto the new Nifty stock market, sorry, the national stock market site, and then they will just facilitate your investment into those companies. Hence the expense ratio is very less, and that is what we need. As we know, the regular funds can't beat these index funds with a heavy price. Hence why should we pay? And that is the idea I'm suggesting. Very blindly go with index fund. If you are in trying to invest into the stock market, your first approach would be, the route you should take is index mutual fund, not the regular mutual. right? So regular mutual funds are simply eating your money with not a value add at all. Okay, so that's it. Keep learning. I would always recommend whatever we are discussing here is a subset of the information that you would need really for you to get successful in the stock market. I'm going to trigger those points and ask you to go through all these very great books among the investment community. Right. One which right now in this class I'm just suggesting you common sense investing, and there is another which is Money Master the Game. All I know, these are the very best books, and they are very big volumes. I mean, you definitely need a dedicated time. Yeah, investment is a fun, but you need to understand the both coins of it, right? Then only it will be fun. Okay, then fine. Then have a great day, and we will talk more on such investment principles. Let's learn together. Okay, bye.